What if I told you that one of the most popular, most heavily marketed investment strategies of the last 3 years is mathematically designed to make you poor, not in a dramatic, lose-it-all overnight way, but in a slow, quiet, and almost invisible way? It's a strategy wrapped in the comforting language of safe income, yield, and lower volatility. It's poured into sleek ETFs that promise to pay you like a second job, and right now, tens of billions of dollars are flowing into it, while the people who understand the math are quietly stepping away. We're talking about the covered call ETF frenzy. And today, in this two-part investigation, we're going to tear down the marketing and expose the machinery. This isn't about bashing a strategy, it's about understanding a trade-off. A trade-off so fundamental that getting it wrong could mean sacrificing hundreds of thousands, maybe even millions of dollars in your long-term wealth. In part 1, we'll expose the core myth and the hidden costs. In part 2, we'll meet the dissenting voices and explore what true financial innovation looks like. But first, let's start with a story that isn't about stocks at all.
Imagine you own a house in a neighborhood that's been consistently increasing in value by about 10% per year for decades. It's your biggest asset. One day, a well-dressed investor knocks on your door. They make you an offer. "I'll pay you a guaranteed 8% of your home's value this year, in cash, right now. In exchange, if the value of your house goes up more than 5% this year, I keep all the gains above that 5%. You still get your 8 tower."
Don't add host. Just flow like you are talking to the audience. What if I told you that one of the most popular, most heavily marketed investment strategies of the last 3 years is mathematically designed to make you poor, not in a dramatic lose-it-all overnight way, but in a slow, quiet, and almost invisible way? It's a strategy wrapped in the comforting language of safe income, yield, and lower volatility. It's poured into sleek ETFs that promise to pay you like a second job. And right now, tens of billions of dollars are flowing into it, while the people who understand the math are quietly stepping away. We're talking about the covered call ETF frenzy. And today, in this two-part investigation, we're going to tear down the marketing and expose the machinery. This isn't about bashing a strategy, it's about understanding a trade-off so fundamental that getting it wrong could mean sacrificing hundreds of thousands, maybe even millions, of dollars in your long-term wealth. In part 1, we'll expose the core myth and the hidden costs. In part 2, we'll meet the dissenting voices and explore what true financial innovation looks like. But first, let's start with a story that isn't about stocks at all.
Imagine you own a house in a neighborhood that's been consistently increasing in value by about 10% per year for decades. It's your biggest asset. One day, a well-dressed investor knocks on your door. They make you an offer. "I'll pay you a guaranteed 8% of your home's value this year, in cash, right now. In exchange, if the value of your house goes up more than 5% this year, I keep all the gains above that 5%. You still get your 8% payment. But if the house value skyrockets 20%, those extra gains are mine. Oh, and if the house value falls, you bear all that loss yourself."
Would you take that deal? Most people intuitively hesitate. You're giving away your unlimited upside, the very reason you own the asset, for a fixed, upfront cash payment. You've capped your potential, but you're still on the hook for 100% of the downside. Now, what if I told you that millions of investors are doing exactly this with their stock portfolios right now, thinking they've found a genius income hack? They haven't. They've just become landlords of their own financial futures, signing away their long-term wealth for a monthly check. This is the psychological engine of the covered call trade, and when it's packaged into an ETF, the mechanics get hidden, the costs multiply, and the long-term consequences become devastating. Let's break down the first and biggest myth, the myth of income. When you see a covered call ETF boasting a 12% distribution rate or a 60% yield, your brain, trained by decades of bonds and savings accounts, interprets that as a return on your money, a safe, steady drip of profit. That is the single most dangerous misunderstanding in finance today. What you are actually seeing is not income in the traditional sense. It is a return of your money, repackaged as a return on your money. Here's the brutal reality. Selling an option, whether a call or a put, is not a value-creating activity. It's a risk transfer activity. You are selling a financial contract, an insurance policy. The premium you collect is your fee for taking on someone else's risk. Just like an insurance company, sometimes you win, the option expires worthless. Sometimes you lose catastrophically, the market moves violently against you. In a true income investment, a bond, a rental property's net cash flow, a company's dividend, the payment comes from an external source of value: interest, rent, profits. In an options premium strategy, the distribution often comes from the fund's own capital. It's a managed payout. They are literally handing you back your own money minus their fees and calling it yield. Don't believe me? Look at any of these high distribution option ETFs. Right next to that eye-popping 30-day distribution rate, the SEC forces them to publish the 30-day SEC yield. That's the regulatory measure of actual income generated. And what do you see? A distribution rate of 50%. And an SEC yield of 0.3%. The regulator is screaming at you, this is not yield. So if it's not real income, what is it? It's a combination of three things. 1. Capital gains distributions. The fund is realizing gains from its trades and paying them out. This is simply converting your unrealized appreciation into a taxable cash event, often at higher short-term rates. 2. Return of capital. In many cases, they are literally paying you from the fund's asset base. Your account value shrinks, and they mail you a check for part of that shrinkage. It's the financial equivalent of sawing off the leg of your chair and handing it to you saying, "Here, I made you a gift." 3. Premium from sold options. This is the only external cash inflow, but as we'll see, it comes with a massive, often hidden liability. This leads us to the second myth, the myth of lower risk. Covered call strategies are marketed as a smoother ride. Generate income in sideways markets. Reduce portfolio volatility. This is a half-truth that ignores the shape of risk. Yes, in a gently declining or flat market, the premium collected can provide a cushion, sometimes leading to less negative performance than the underlying index. This is the cash flow people feel. It feels safe, but you have not eliminated risk, you have transformed it. You have traded the risk of short-term volatility for the near certainty of long-term return erosion and the potential for asymmetric, catastrophic loss. Let's visualize this with a concept every options trader knows but is rarely shown to retail investors: the payoff diagram. This green line here shows the profit profile of simply buying and holding the S&P 500. It's a straight, upward-sloping diagonal. If the market goes up 20%, you make 20%. Your upside is unlimited. Your downside is, of course, your full investment. Now, let's overlay the classic covered call strategy, owning the S&P 500 and selling a call option at, say, a 5% higher strike price. See what happens? The orange line matches the green line for a bit. Then, at the strike price, it goes completely flat. Your upside is capped. You have sold your birthright of unlimited compounding for a fixed fee. In a strong bull market, you massively underperform. This is the silent, invisible cost. The opportunity cost of gains you never see. Now let's look at the downside. Notice, both lines fall at almost the same slope. The premium you collected provides a tiny, one-time buffer, maybe 2–3%, and then you are exposed to nearly the full downside of the market. You have not bought a put, you have not insured your portfolio, you have given away your lottery ticket but kept the liability for the house fire. This is the brutal math. You give away unlimited upside for a small, fixed premium while retaining almost all of the downside. But wait, it gets worse. Because we're not talking about a one-time trade an investor thoughtfully makes. We're talking about an ETF that does this systematically, weekly or monthly, resetting the trap over and over. This brings us to the third and most devastating myth, the myth of efficiency. This is where the institutional machinery grinds away retail wealth. An individual might sell a covered call once a quarter. A covered call ETF is a factory. It's selling and buying back options contracts constantly, every week, every month, to maintain its exposure. Each of those trades comes with a cost, and these costs are the silent killers of the strategy. 1. The bid-ask spread. This is the difference between the price at which you can sell an option, the bid, and the price at which you can buy it, the ask. For liquid ETFs like SPY, it's tiny. But many of these covered call ETFs write options on less liquid holdings or on individual stocks. The spread can be wide. Every single time the fund rolls its options, closes the old one and sells a new one, it crosses this spread. It buys at the high ask and sells at the low bid. That's an immediate frictionless loss. Do that 52 times a year, and the drag is enormous. 2. Commission and execution costs. While commissions are low, for a fund trading millions of contracts, they add up to real money, paid out of the fund's assets, your assets. 3. The implied volatility trap. This is a nuanced but critical point. Options are priced based on implied volatility, the market's forecast of future turbulence. Covered call ETFs are most often selling volatility. Historically, implied volatility tends to be higher than the realized volatility that actually occurs. This difference is called the volatility risk premium, and it's the theoretical edge for sellers. But this premium is not a monolith. It's not evenly distributed. Academic research shows this premium is often most concentrated in out-of-the-money put options, the ones that protect against crashes, not in the at-the-money calls that these ETFs are typically selling. They might be harvesting a tiny, inefficient slice of the premium while ignoring the juicier, riskier parts. They're picking up pennies, not dollars. 4. The reset problem in a downturn. Imagine the market drops 10% in a month. Your covered call ETF collects its 1% premium, but is down 9% net. Now it resets. It has to sell new calls, but now it's selling them 10% lower. The potential for a rebound is now locked in at a much lower ceiling. If the market then rallies 10% back to even, the fund is still down, because it missed the entire recovery. It's like falling into a hole and selling your ladder for cash on the way down. Let's talk about a real-world case study that isn't a covered call ETF, but is a masterclass in the risks of systematic short volatility strategies, the ETFs catastrophe of February 2018. Graphic shows the vertiginous collapse of the Velocity Shares daily inverse VIX ETN 14th from $140 to $4 in a single day. 14th was an exchange-traded note that used complex derivatives to bet that market volatility would always go down. For years, it worked beautifully. It became the can't-lose trade. Yield chasers piled in. Then, on February 5, 2018, the VIX Volatility Index spiked over 100% in a single day. 14th wasn't just a fund that lost money. It was a structure that was mathematically guaranteed to be wiped out by such a move. It lost 96% of its value overnight and was terminated. Now, covered call ETFs are not as explosively risky as part-time. They won't go to zero in a day. But they operate on a similar philosophical principle, systematically selling volatility, via calls, to harvest premiums, assuming markets will generally be calm. They are selling insurance against big up moves. What happens in a sustained low volatility bull market that suddenly erupts into a rapid violent upside move? Think the meme stock frenzy of 2021, but on an index level. The fund would not only miss the gains but would be forced to buy back its short calls at astronomical prices to close the position, locking in massive losses on the derivative side while the underlying holdings soar. The NAV would get crushed from both sides. This brings us to the final, and perhaps most cynical, part of the modern covered call ETF boom, the marketing arbitrage. There is a reason you see these funds advertised everywhere, on YouTube, Twitter, financial news. The economics are perfect for the issuer. 1. Eyeball-grabbing numbers. 12% yield in a 4% world is an irresistible click. 2. High-fee justification. These strategies are complex to run, or at least, they can charge for that complexity. They often carry expense ratios of 0.60%, 0.75%, even higher. Compare that to 0.0% for a vanilla S&P 500 ETF. That's a 20x markup. 3. Built-in churn and confusion. The strategy is just complicated enough that the average investor can't easily deconstruct it, but just simple enough to sound like a smart income hack. The toxic tax inefficiency, distributing short-term gains, and the NAV erosion are slow-moving, allowing the fund to gather assets for years before the long-term underperformance becomes undeniably obvious in an investor's account. The issuers win on high fees. The brokers win on commissions from the constant options trading. The marketers win on clicks. Who loses? The buy and hold investor in the fund, who over a 10-20 year period will almost certainly lag the underlying index by a margin that consumes all those yield payments, and then some. We started with a house analogy. Let's end this part with the portfolio math. Assume two investors start with $100,000 in 1990, right before one of history's greatest bull markets. Investor A buys and holds the S&P 500, SPY. They reinvest dividends. They do nothing. Investor B uses a S&P 500 plus covered call strategy, will be generous and model it efficiently. It captures 80% of the market's downside, but caps upside at 70% of the market's gains in up years, and collects an average premium 2% per year. By the end of 2023, after 33 years in stocks, Investor A's $100,000 is worth $2.4 million. Investor B's $100,000 is worth $1.1 million. Investor B received monthly income checks that felt great. They had a smoother emotional ride, but they are $1.3 million poorer than Investor A. They traded peace of mind for generational wealth. That is the cover call trap. It's a trade that optimizes for feeling good in the short term, while systematically destroying long-term compound growth. But is the story really that simple? Is there any legitimate use for these strategies? Are all the people running these funds just charlatans? Or is there a deeper layer to this where the real problem isn't the tool, but how it's been weaponized by marketing and misunderstood by investors? In part 2, we're going to move from critique to conversation. We'll bring in the actual arguments from sophisticated practitioners who defend a different kind of options-based investing. We'll sit down with the quant who argues that the problem isn't selling options, it's being a strike seller without an edge. We'll hear from the CEO, who believes these strategies can work, but only in specific liquid asset classes, and with active dynamic risk management, not as a blind systematic cap. And we'll hear the purist case against any use of derivatives at all. We'll explore the questions that matter. Is there actually a volatility risk premium to be harvested, and if so, how? What does it mean to have edge in options trading? And for an individual investor nearing retirement, terrified of market drops, is there a legitimate, non-destructive place for these instruments? The answer isn't black and white, but understanding the grays is the difference between being a product consumer and being a portfolio architect. But what if that's only half the story? What if the tool itself isn't evil, but the way it's been mass-produced, dumbed down and sold to the public is? What if in the right hands, with the right philosophy, options can be used not as a crutch for yield chasing, but as a scalpel for precision? Today, in part 2, we're leaving the world of marketing and entering the world of implementation. We're going to hear from the other side, not from salespeople, but from quants, portfolio managers, and dissenters who see the same data we do and have come to very different conclusions. Because finance is rarely about universal truths. It's about trade-offs, edges, and knowing exactly what game you're playing. Let's start by reframing the entire debate. In part 1, I said selling options is a zero-sum game. That's technically true for every single contract. For every winner, a loser. But that doesn't mean the premium itself is a mirage. It represents something real, the price of risk transfer. Think of it like the insurance industry again. For every homeowner who pays a premium and never files a claim, a loser in the zero-sum trade with the insurer. There's one whose house burns down and gets a payout, the winner. The insurance company doesn't make money by hoping disasters don't happen. It makes money by accurately pricing risk. It collects premiums that, in aggregate and over time, exceed the payouts it must make, plus its costs. Its edge is in actuarial science and diversification.
The argument made by sophisticated options managers is this: the mass market systematic covered call ETF is like an insurance company that sets its prices by looking at what its competitors charge, not by doing its own actuarial math. It has no edge. It's just a strike seller.
What does edge mean in options? It's not about predicting the market's direction. It's about identifying mispricings in the volatility surface itself. This is the implied volatility surface. It shows how the market is pricing options at different strike prices and expirations. It's not flat. It has a shape. After the 1987 crash and the tech bubble, the surface for indices like the S&P 500 developed a pronounced skew. Out-of-the-money put options, crash protection, are priced with much higher implied volatility than out-of-the-money call options. The market is terrified of crashes and is willing to overpay for protection against them. It's relatively complacent about explosive upside. This creates a potential inefficiency. The academic volatility risk premium, the tendency for implied vol to be higher than realized vol, is not evenly distributed. It is often concentrated in those expensive out-of-the-money puts. A systematic covered call ETF, selling at the money calls, is barely scraping the edge of this premium. It's harvesting the crumbs. A manager with an edge is looking at this surface like a topographical map, asking, where is the market's fear or greed causing a persistent distortion? Where is the price of risk wrong?
Let's make this concrete with a historical example. Look at the volatility index VIX term structure over the past decade. For years, the VIX futures market was in a state called contango. The market was consistently pricing future volatility as higher than current volatility. A systematic, brainless strategy of shorting VIX futures, betting volatility would fall, made easy money for years. It was the short vol trade. It became so crowded it was a meme: short vol and go play golf. This was the environment that birthed products like 40. But what was really happening? The market wasn't wrong per se. It was expressing a constant structural fear of a future spike. It was overpaying for protection against a future that mostly didn't happen. The edge wasn't in predicting when the spike would come, but in understanding that the price of that protection was, on average, too high. This is a form of carry trade. Then February 2018 happened. The spike came. The overpriced insurance was finally needed. The sellers who were just harvesting carry without a dynamic risk management plan were wiped out. The lesson from a professional like a former market maker or volatility arbitrageur is, you cannot just be a seller. You have to be a trader. You have to actively manage the risk. You have to be able to say, the skew is too flat today, I'll sell calls. And the skew is too steep tomorrow, I'll sell puts. Or implied volatility is screamingly expensive versus history, I'll sell more. And volatility is cheap, I'll step back or even buy. This is a world away from the ETF that robotically sells a call at 5% out of the money every single Friday, no matter what.
This brings us to the crucial distinction one quant made in our source material. Strike seller versus volatility risk premier harvester. The strike seller, this is the classic covered call ETF. Its mandate is simple: generate premium income. It picks a delta, e.g. sell a call with a 0.30 delta, sells it, waits for expiry, and does it again. It is path dependent and vulnerable to whipsaws. It has no view on whether volatility is cheap or expensive. It is a factory. The volatility risk premier. Harvester. This manager's mandate is to maintain a target portfolio risk profile, e.g. a beta of 1.0 to the S&P, and add a stream of returns on top by exploiting perceived mispricings in options. They are constantly rebalancing their options book to keep risk constant. They might be long options in one part of the surface and short in another, a relative value trade. Their goal isn't income, it's alpha, excess return derived from skill. The cash flows from this look like income, but they are the byproduct of a risk transfer business with a targeted edge.
So, is there a case for the harvester in a retail portfolio? One argument goes like this. For a retiree, a portion of their portfolio is allocated to risky credit, corporate bonds, high-yield debt. That investor is being compensated with a yield that consists of the risk-free rate, T-bills, plus a credit spread for taking on default risk. Historically, that credit spread has at times provided very little excess return after defaults. What if, the argument goes, you replace that risky credit sleeve with a carefully managed high-conviction volatility selling program? One that invests its collateral in safe T-bills and uses options to generate the spread. If the volatility risk premium is more robust and offers better risk-adjusted returns than the credit risk premium, you might have a more efficient portfolio. It's not for yield, it's for portable alpha. This is a highly sophisticated argument. It's not get 12% income. It's, we believe we can construct a strategy that delivers a better Sharpe ratio than your current alternative in the enhanced income or alternative bucket of your portfolio. Now, let's introduce the elephant in the room: liquidity and cost. Even the smartest volatility harvester is dead in the water if they're trading in a swamp. The single biggest practical critique from the skeptics is about bid-ask spreads and execution. Remember, every roll is a cost. If you're trading options on the S&P 500, SPX SPY, or NASDAQ 100, NDXQQQ, you're in the most liquid derivatives market on Earth. The spreads are razor thin. The friction is minimal. But what about a covered call ETF that writes calls on 100 individual small-cap stocks, or on a niche sector, or on a proprietary index? The liquidity dries up, the spreads widen, the market maker's profit margin on your trade balloons. The edge you might theoretically have is instantly consumed by friction. The fund isn't harvesting a risk premium, it's subsidizing the market maker's yacht payment.
This is the death knell for many of these products. They are sold on a back-tested theory that ignores the real cost of trading in size in illiquid markets. As one critic bluntly put it, the majority of the options ETFs we see out there are trading securities that don't have a very tight bid-ask spread, and you are getting eaten away on a lot of these rolls.
So, if we were to imagine a best-case scenario for an options income strategy, it might look like this. 1. Liquid underlying, S&P 500, NASDAQ 100, maybe gold or Bitcoin futures. 2. Active not systematic, a manager with discretion to adjust strikes, maturities, and even be long or short volatility based on a proprietary model. 3. Clear risk targeting, a focus on maintaining a specific delta beta, not just selling strikes. 4. Tax awareness, using structures like flexible exchange options, flex options, or managing within an ETF wrapper to minimize the horrific tax drag of constant short-term gains distributions. 5. Transparent communication, calling it derivatives-based return stream, or volatility alpha, not income or yield. Does this exist? There are a handful of funds and upcoming ETFs that claim this philosophy. They are not the ones with the 50% distribution rates. Their targeted returns are far more modest, because they're not returning your own capital to you.
Now, let's bring back the strongest counter-argument, the purist's view, perfectly articulated by a manager who runs a top-performing long-only growth ETF. His case is elegant in its simplicity. You should never cap the upside on assets you are most bullish on. If you own a concentrated portfolio of companies you believe will change the world, why would you ever sell a call option against them? You are literally selling your conviction for cash. It's a philosophical contradiction. His second point is about the retail investor's only true edge, time horizon and the absence of leverage. Institutions have quarterly marks, redemptions, leverage covenants. They can be forced sellers. You cannot. Your superpower is that you can buy a great company or a low-cost index fund and do nothing for 30 years. You can compound tax efficiently through every cycle. The moment you introduce options, you give up that superpower. You enter the domain of expiration dates, rolling costs, gamma risk, and theta decay. You are playing a game where the opponents are supercomputers, market makers, and multi-billion-dollar quant funds. Your edge evaporates. His final devastating point is on tax efficiency. A long-only equity ETF like his or like the S&P 500 SPDR, SPY, is a marvel of tax engineering. It rarely distributes capital gains. You pay taxes only when you decide to sell, and it's at long-term capital gains rates. A covered call ETF is a tax nightmare, constantly distributing short-term gains as income, saddling you with a tax bill every year while the fund's NAV erodes. When you finally go to sell the depleted fund, you get a capital loss that you often can't even use to offset the ordinary income you've already been taxed on. It's the worst of all worlds.
So, where does this leave us, the individual investors? It leaves us with a hierarchy of understanding, a ladder you can climb based on your own goals, sophistication, and self-awareness. Level 1, the avoider. You understand the math from part 1. You see these funds as a product designed to separate you from your long-term compounding potential through slick marketing. You stick to your core philosophy, broad-based, low-cost equity index funds for growth. You use a simple 4% rule, or systematic share sales for retirement income. You win by not playing the loser's game. Level 2, the sophisticated allocator. You have a multi-million-dollar portfolio. You have an alternatives bucket. You might allocate a small slice, 5 to 10%, to a truly active, institutional quality volatility manager after intense due diligence. You don't do it for yield, but for diversification and a different return stream. You understand it's a risky skill-based strategy, not a bond substitute. Level 3, the speculator trader. You use options intentionally in a separate risk capital account. You might sell puts to enter a stock position at a lower price. You might buy calls for leverage bets. You might run a small defined risk covered call strategy on a single stock you're neutral on. but you know it's trading, not investing. You size it appropriately. You would never put your core retirement assets into it. The tragedy is that tens of thousands of investors are trying to operate at level 2 or 3, but they're buying level 1 products, mass market covered call ETFs, thinking they've found a safe shortcut. They haven't. They found the most expensive, inefficient, and poorly constructed version of the complex strategy they think they're implementing. The ultimate takeaway from this deep dive isn't covered calls bad. It's this. In finance, if something looks like a free lunch, high income with low risk, you are not the customer. You are the product being sold to. The yield is the bait. Your trapped capital and fees are the real harvest. True financial innovation doesn't dress up old, suboptimal trades in a new ETF wrapper. It solves a real problem with intellectual honesty. Whether it's the purists' focus on tax-efficient compounding or the quants' search for legitimate alpha in volatility markets, the common thread is a respect for the math, a clarity about the trade-offs, and an honesty about the risks. Your job is to know which game you're in. Are you in the slow, steady game of compounding ownership into the world's best companies? Or are you in the fast, zero-sum game of trading volatility contracts? Choose wisely. Because the market is a ruthless machine for transferring wealth from the impatient, the emotional, and the confused to the patient, the disciplined, and the clear-eyed. Don't let a monthly distribution check cloud your vision of the mountain of wealth you're trying to build. Let me know in the comments, did this change your perspective? Are you a purist, a skeptic, or do you see a legitimate place for these strategies? The conversation is where the real learning happens.